Welcome back to another episode of Asset Coach and Tax Strategist. And so today's episode, we're going to go through an article written by Kiplinger on how the IRS taxes retirement. Now, at the time of this recording, we just had the inauguration of Trump in his second term. So we do know that there are some changes that are going to occur to the tax system. So we're not giving tax advice. We're not giving financial advice. We're not giving legal advice. This is just for educational purposes only. So please take it as such, as just education. Go do your own research, ask your own professionals about this information. This is just to give you high level. So I'm going to go ahead and share my screen here. And we're going to dive into how this works. So here we go. How the IRS taxes retirement income. Now, it's important to know that this is from Kiplinger.com. So you can see that here up at the top. And let's kind of go through some of this. And I apologize for these little video pop-up ads. These are so annoying. But when we use free articles like this and give credit to articles like this by Kelly Taylor, this was updated November 13th, 2024. Again, the time of this recording, we're in January 25, just after the Trump inauguration. So some of these may actually be changing. So is retirement income taxable? Yes. Now, here's something we tell all of our clients, all of our members. We have this saying, income is taxable, cash flow is plannable. So we needed to have the distinction of what's creating our income. Okay, so we have a video, if you haven't seen it, called the income funnel. Go check out our video describing and explaining what the income funnel is. But as your cash flow and some of your cash flow gets designated to go down the income funnel, that becomes income. So depending on if it's W-2 salary, 1099, K-1, whatever it is, it's going to be taxed a certain type of income. Now, comprehensive retirement planning involves considering various sources of income and understanding how they are taxed by the federal and state levels. Okay, so now we need to look at what types are taxed. So now, at the time of this recording, again, Social Security benefits are taxable. We do know that Trump ran his presidential re-election, as well as just being sworn in, may change the taxation on Social Security tax at retirement, Social Security benefits taxed at retirement. Okay, so at the time of this recording, that has not occurred yet. So what is taxed? Well, how some income in retirement is taxed. I think this is a great breakdown, actually. Social Security benefits, depending on your provisional income, up to 85% of your Social Security benefit can be taxed. Okay, provisional income, the IRS has a full definition of what provisional income is. So let's go ahead and see if we can find what this means. Provisional income is calculated figure used to determine whether a portion of Social Security benefits is taxable. Okay, so what is considered provisional income? I want to go through here really quickly and see if this gives us a good definition. I give you a definition, but I want to use what's more up to date as information to help determine this answer for you. This isn't going to give it to us. Okay, provisional income is unrelated to provisional. So provisional tax is unrelated to provisional income. Provisional tax is a method of paying tax liabilities in advance to make sure that taxpayer is not burdened by a large tax debt. Let's see here. Do Roth IRA withdrawals count as combined income? No, Roth IRA withdrawals are not counted as in combined income in calculating combined income. So it's tax-free income, so it wouldn't be considered as income in your provisional income structure for Social Security benefits. So anyway, so let's go back to here and not go down a rabbit hole. I apologize. Pension plans. Pension payments are generally fully taxable as ordinary income unless you made an after-tax contribution. So pension plans are structured. There's not a lot of pension plans around anymore. Most pension plans are governmental. There are some after-tax contribution structures and pension plans, and we won't go into the different types of pension plans on this video, but generally they're fully taxable as ordinary income. Okay, we can look at, okay, we'll get down there. Interest-bearing accounts, interests are taxed as ordinary income rates, but municipal bond interest is exempt from federal tax and may be exempt from state tax. Now, municipal bonds are exempt from state tax if it's a municipal bond in the state you earn income, so that you're resident. So let's say you live in California and you bought a municipal bond in the state of California for a municipality in the state of California, then technically it would be federally and state exempt from income taxes. But again, reach out to your financial and tax advisors as to verifying that. Now, sales of stock, bonds, and mutual funds, long-term gains are held over a year, and that's based on your income. Is if to your taxable income, if you're going to be paying 0% long-term gains, 15%, or 20% in long-term capital gains. Short-term is considered basically ordinary income. So anything less than a year would be considered ordinary income. Net investment income tax, NNIT, it is a factor in some investor situation, and it's an additional 3.8% taxation. This is really what we call the Obamacare tax. This is how Obamacare is getting quote unquote paid for. Dividends, qualified dividends are taxed as long-term gains like interest, but non-qualified dividends are taxed as ordinary income based on your federal tax bracket. And you'll know what those are when you have them. Again, if you're not sure what that looks like, talk to your financial and tax advisors. Your traditional IRA and your 401ks are contributions, are usually taxable income as ordinary income. And if you're at age 73 or older, you're going to have required minimum distributions. Now, you may be of an age where the RMD, the minimum distribution, was 70 and a half or even 72. But current law at the time of this recording, the new required minimum distribution age is 73. And anything at 59 and a half or early would be considered taxable income or ordinary income tax. If you took withdrawals, distributions out of your IRA and 401ks before 59 and a half, just know that if you do that, there is a potential tax penalty for early withdrawal. Again, to seek your financial and tax advisors for that information. Now, Roth IRAs and Roth 401k contributions are not deductible. They're not tax deductible like traditional IRA and 401ks. Usually your contribution is a reduction of your taxation, of your income taxation. Roth IRAs and Roth 401ks are not. They're non-taxable. They're after tax. So that means withdrawals after 5 years of your first contributions essentially are tax-free. But if you do withdraw or distribute before 59 and a half, there is that tax penalty subject to the amount that you withdrew before 59 and a half. Not on the full amount of your balance, but what you did withdraw or distribute out of that. Life insurance proceeds. Life insurance proceeds are generally not subject to tax when received as a beneficiary. This is at death. Now, life insurance proceeds. What they're not talking about is the cash value. Now, surrendering a policy for cash may have tax implications, but if you don't surrender your policy and you borrow your cash from your life insurance, there's a strong possibility, very strong possibility, that that is a non-taxable event. But if you do surrender the policy with having this policy loan on your policy, the amount that you did withdraw or borrow previously, which was a loan, and you surrendered your policy, that amount, that the outstanding balance would be considered taxable income and have taxable implications. Please seek your tax advisor as to verify this. Savings bonds interest is generally taxable as ordinary income rates upon maturity and redemption, but may be tax-free for educational expenses if certain conditions are met. Okay, so you have to seek that and seek your financial advisor and tax advisor for that information. Annuities, a portion representing the principal, is tax-free, meaning when an annuity, you take a lump sum or a contribution amount, that's your principal, that is not taxable. Okay, because you didn't get a deduction up front like a traditional IRA and or 401k. We're just talking about a standalone annuity. Now, if you used one of those structures and an annuity as the investment vehicle in a traditional IRA, there may be the potential that it was a deductible expense. But here we're talking about just an annuity structured as a non-qualified annuity. And then earnings are taxed as ordinary income rates unless purchased pre-tax funds. Again, seek your probably your insurance advisor as well as your tax advisor on that. Home sales under Section 121 have an exclusion. Primary home sales gain up to $250,000 for an individual, $500,000 for a married couple. What that means is that the equity, the gain on that property, not the loan pay down, but you bought your house for, let's say, $100,000. And it grew to 300,000. Okay. So even though you paid your loan down of 100,000, okay, and it's now worth 300,000, that 300 minus the purchase price, that's your gain. That's what they're saying is excluded from income tax up to these amounts. So under Section 121. Now, which states don't tax retirement income? This is a great thing for you to be able to take a look at. There are a handful of states that don't tax retirement income because they don't have any state income tax. So you need to check that out. Talk to your tax advisor for that information. And other than that, thank you so much for investing your time with us. And if you like this content or you want more of this content, give us a thumbs up or in the comment section, let us know what else you want to look at. This is an asset coach and tax strategist YouTube channel. So we want to look at all assets and we want to look at tax strategies. We want to look at how money and assets work in this channel. So if that's something that you're interested in, if you like our content, give us a thumbs up. Feel free to share us with your friends and colleagues. That's okay. We accept referrals. So thanks so much. Make it a great day. Bye-bye.